Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through the market's weakness. Today, we're putting a giant under the forge, KKR. Their latest earnings report just hit the street. And on the surface, it really looks like there might be some cracks forming in the foundation. The stock took a pretty decent hit, and all the headlines were screaming one thing: earnings miss.
But hold on a second, because when you actually do the heavy lifting, when you get in there and you start stress testing the structural integrity of this company, a completely different picture starts to emerge. And it's a picture of overwhelming financial strength and, maybe more importantly, a really clear blueprint for future dominance.
That's exactly right. So today, we are going to dissect these numbers. We're going to stress test the bull case, we're going to stress test the bear case, and we're going to figure out, definitively, if this is a company that's really showing signs of weakness, or if the market just handed smart, patient investors an absolutely ironclad opportunity.
So, right out of the gate, we're staring at this massive contradiction. I mean, the market is supposed to be this rational, all-knowing machine, right? But its reaction here was just so immediate, so negative. It's like they saw the report and just slammed the sell button as hard as they could. So you have to ask, was that a calculated move? Was it based on a deep dive into the numbers? Or was it just a classic knee-jerk reaction to a single scary headline?
That is the billion-dollar question we have to answer today. Did all the trading algorithms and the quick-triggered traders out there just see the word miss and completely fail to read the rest of the report? Because, when you really get your hands dirty and dig into the details here, it becomes incredibly clear that there's a much bigger, much stronger story unfolding. A story that this initial sell-off seems to have completely and totally ignored.
Okay, so this right here, this slide shows you the sheer scale of that disconnect. I mean, this is the whole conflict of the KKR story in a nutshell. Over on the left, you've got the reason for all the fear in the market. Adjusted earnings per share, or EPS, came in at $1.12. Now, the consensus estimate was $1.14, so they missed by 2 cents, a tiny, tiny crack. But then you look over at the right. This is the reality that the market just glossed over. Revenue didn't just beat the forecasts, it absolutely shattered them. Analysts were looking for something like $2.1 billion. KKR came in and delivered $5.74 billion. That isn't a beat, my friends, that is a demolition. That is a 172% surprise.
So how is that even possible? How can a company miss on its earnings by 2 measly pennies, while at the exact same time blowing its revenue forecasts completely out of the water by more than $3.5 billion? That's the puzzle we're here to solve.
All right, so let's tackle this head on. Let's start with the bear case. I need to understand exactly what the market saw that made it get so spooked. Why in the world did that 2-cent earnings miss carry so much more weight than a multi-billion-dollar beat on revenue? Let's get in there, let's examine the numbers that scared the investors, and let's see if those fears were actually justified or if it was just a massive overreaction to some short-term noise.
And here you have it, the immediate result of that fear. This isn't theoretical, this is the tangible, real-world evidence of the market's verdict. Before the earnings call was even over, before anyone had time to really digest what they were hearing, the stock dropped almost 4% in pre-market trading. Now that's not just a minor dip, that's a significant move. It tells you that a huge volume of capital made the decision to get out, and get out fast. This reaction is the first big piece of our puzzle. It shows that for a lot of people out there, that negative headline was the only thing that mattered. The fear of an earnings miss, no matter how small it was, outweighed absolutely everything else in that report.
And here are the cold, hard facts. We can't ignore this. We have to confront it. The reported earnings per share was $1.12. The street, Wall Street, was expecting $1.14. So yes, by definition, it's a miss. There's no way to spin that. The company came in 2 cents short of what everyone was expecting. And look, for a lot of automated trading systems and for investors who just trade off the headlines, this is exactly where the analysis stops. Miss equals sell. End of story. But for us, this is where the real work begins. We have to ask, why did they miss? What specific things happened that led to this number? That is the critical question.
Okay, so let's pick up our tools and start inspecting the structure. If this EPS miss is really a crack in the armor, we have to figure out what kind of crack it is. Is it just a superficial scratch? Something caused by a one-time event that doesn't really matter in the long run? Or is it something more serious, a deep structural fracture that suggests a systemic weakness in the company? The headline alone just doesn't tell you that.
Exactly. So now we're going to move beyond that surface level number. We are going to dissect the components of KKR's income statement to find the true source of the pressure.
And this quote, this is from The Edge Singapore. It gets us right to the heart of the matter.
it pinpoints the two primary culprits behind that drop in adjusted net income. So first, you have lower deal exits, fewer asset sales. And that's really just a reflection of the broader market environment. It's tough to sell things right now. But the second one, and this is far more specific, is something they call the Asia clawback. Now, this isn't some general market trend. This is a very specific one-time charge, and it's related to one single fund. This right here, this is the key that's going to unlock this entire earnings puzzle for us. All right, so let's break that down. What exactly is a clawback? I mean, it sounds bad. It sounds like the company did something wrong, and now they're being punished for it. It does sound bad, but it's actually a pretty standard feature in the world of private equity, and it's designed to protect investors. So here's how it works. Essentially, let's say a fund has some early successes and it pays out performance fees to the managers. But then, later on, other investments in that very same fund don't do so well. Well, the firm is then contractually obligated to return, or claw back, some of those fees they were paid earlier. In KKR's case, this was a specific $350 million repayment obligation, and it was tied directly to their Asia 2 fund. The absolutely crucial point here is that this is an accounting charge. It's related to past performance on one specific fund. It is not a reflection of some broad operational failure happening across the entire company in the current quarter. It's just a retroactive adjustment.
Wow. And this just brilliantly illustrates the impact of that single charge. So let me get this straight. You're telling me that if you just remove that one-time non-operational Asia clawback, KKR's earnings per share for the quarter wasn't $1.12? It was actually $1.30?
Let that sink in for a moment. Without that one single charge, KKR didn't miss estimates by 2 cents. They beat estimates by a whopping 16 cents. The entire narrative just flips completely on its head. That crack in the armor the market freaked out about, it wasn't a structural failure at all. It was just a single, non-recurring accounting item. The market sold off based on a headline that was, technically true, but substantively, it was incredibly misleading.
Okay, so now we pivot. Because while the market was completely distracted by that surface-level noise, by that one little accounting item, KKR was busy with some serious heavy construction. This is where we stop dissecting a minor crack and we start analyzing the massive ironclad fortress that they've been building. And let me tell you, the numbers we're about to look at, they don't just counter the narrative of weakness, they completely overwhelm it with undeniable evidence of incredible financial strength and powerful momentum. Let's take a look at the foundation they are pouring.
This right here, this is the first pillar of that fortress. $129 billion in new capital, raised in a single year. Now, to put that into perspective for you, this wasn't just, a good year. This was the single greatest fundraising year in the company's entire 50-year history. And get this, they pulled this off during what many analysts were calling a very challenging fundraising environment. While their competitors were struggling to raise capital, KKR was out there setting all-time records. This is a massive, massive vote of confidence from the world's most sophisticated institutional investors. These people are not worried about a 2-cent earnings miss. They're committing billions and billions of dollars to KKR's long-term strategy.
And all of that fundraising, it has a direct, powerful impact on the sheer scale of the operation. KKR's total assets under management, we call it AUM, it surged to $744 billion. That is a 17% increase from the previous year. Okay, that's a huge number, I get it. But break it down for us. Why does AUM matter so much? What's the big deal? It's a huge deal because it represents growing power and influence in the market. More AUM means more management fees, and those are stable and predictable revenue streams. It means they have more capital to deploy when they see opportunities, and it means they have a larger, more diversified platform that's much more resilient to shocks in any single market or any single industry. The fortress, my friend, is getting bigger and it's getting stronger.
Now let's talk about the quality of those earnings. This is so important. This isn't about volatile one-time performance fees that only come when you sell an asset. No. This is the bedrock of the company. These are the management fees, the predictable, recurring revenue that KKR earns just for managing that huge pool of capital. And those fees grew by an incredible 24% year over year. That in turn drove their fee-related earnings up by 15%. This is the engine room of the company. It is the steady, powerful cash flow stream that funds operations, it pays dividends, and it provides a stable foundation no matter what the ups and downs of the deal-making environment look like. This is what structural strength looks like.
But is that foundation just resting on one single pillar? I mean, what happens if one area, like private equity, really slows down? Are they vulnerable?
That's a crucial question, and this slide right here shows exactly why that's not a big concern. KKR's management fee base is just beautifully diversified across three massive, distinct engines. You've got private equity, you've got real assets, think infrastructure and real estate, and you've got credit. And as you can see, each one contributes roughly 1/3 of the total. So what does that mean? It means if the private equity exit market is slow, the strength in infrastructure and private credit can easily carry the load. This three-pillared structure provides immense stability and resilience. It's like an all-weather design built to withstand turmoil in any single sector, which is exactly what you want to see if you're looking for a long-term holding.
And this quote from co-CEO Scott Nuttall, it just perfectly captures the mindset inside this fortress. They don't fear market volatility. They welcome it. They thrive on it. With $118 billion of dry powder, that's capital that's just sitting there ready to be deployed, market dislocations and fear-driven sell-offs are not threats to them. They are buying opportunities. This is the predator's mindset. While everybody else is panicking and selling, KKR is armed with a mountain of capital ready to go out and acquire high-quality assets at attractive prices. This is how they turn short-term market weakness into long-term value creation.
Okay, I'm sold. The foundation is rock solid. But a fortress can't just stand still, right? It has to expand its territory. So what is KKR's plan for the future? Is there a clear strategy for growth, or are they just going to sit on their giant pile of assets? The market might be worried about what happened last quarter, but what I really want to see is the blueprint for the next decade. Did they give us one?
Oh, they didn't just give us one. They just unveiled a massive one.
This is their next big bet, and it's a huge one. At the same time they released their earnings, KKR announced the acquisition of a company called Arctos Partners. Now, this isn't just any company. Arctos is the undisputed leader in a fascinating and really fast-growing niche, investing in professional sports franchises. Think about that. They are the only firm that's approved for multi-team ownership across all 5 major U.S. leagues. So this acquisition, it isn't some random side bet. It's a calculated, strategic move to immediately become the dominant player in a brand new, high-growth asset class. And this acquisition is really just the first step in a much, much grander plan. As you can see on this slide, the strategy is crystal clear. So first, they acquire Arctos to instantly get that leadership position and all that expertise. Second, they're going to use that as the cornerstone to launch a brand new division called KKR Solutions. This is going to be a fourth pillar for the entire company, and it's going to focus on sports, on providing solutions for other asset managers, and on secondary market strategies. And third, the target here is just immense.
A fourth pillar. And they're aiming for over $100 billion in assets under management in that new vertical alone. That's not just growth. That's empire building.
Exactly. They are not thinking small here. This is a clear, ambitious blueprint for creating another massive engine of growth for the entire firm.
That is a seriously ambitious plan, but is it just hopeful talk? I mean, are they putting any hard numbers behind all that confidence? They absolutely are. Just look at this guidance for the coming year. They're telling the market they are targeting over $7 per share of adjusted net income. They explicitly say they expect to meaningfully exceed their already ambitious fundraising targets and their fee-related earnings targets. This is not the language of a management team that's worried or on the defensive. This is the language of a team that sees nothing but clear skies and a powerful tailwind at their back. They are setting an incredibly high bar for themselves, and they are telling the market loud and clear that they fully intend to sail right over it.
So now, it is time to bring it all together. We have examined the cracks, and we have surveyed the fortress. It's time to place the short-term noise of the bear case directly up against the long-term structural integrity of the bull case.
Let's do it. Let's put them side by side in the forge, and let's hammer out a final, clear verdict on KKR's true condition.
All right, the whole story is right here on this slide. Let's just weigh the evidence. The entire bear case, everything the market was scared of, it rests on that left-hand column. An EPS miss of 2 cents, which we now know was entirely caused by that one-time clawback charge listed right below it. A temporary stock drop based on that headline, and, the general risks of market volatility that affect everyone. It's all just short-term noise. Now look at the right. The bull case is built on an ironclad structure. A revenue beat of over 170%. A record-breaking, history-making fundraising year. Massive growth in assets and the stable recurring management fees that come with it. A bold, strategic acquisition to build a whole new engine of growth. And forward guidance that just radiates confidence. The weight of the evidence here, it isn't even a balanced scale. It is overwhelmingly tilted toward the bull case.
The structural factors on the right are simply more powerful and much more indicative of long-term health than the transient issues you see on the left.
And so that brings us to the final critical question, the one that you, the investor, have to answer for yourself. We've laid out the full blueprint for you. We've shown you that the market's initial fearful reaction was based on a surface-level crack while completely ignoring the massive, reinforced foundation being built right underneath. So, is that fear you saw in the market a genuine warning sign of trouble to come? Or is it simply the heat and the pressure of the forge creating a rare opportunity to acquire a piece of an exceptionally strong company at a nice discount?
The evidence is before you. The choice, as always, is yours. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.